Friends, today's video is about how you can earn additional income along with your salary. Is there a possibility of having this additional income being deposited into your bank account along with your active salary being deposited? So friends, please subscribe, please share it to your friends and relatives so that they can as well get knowledge about the methods which I'm going to share in this particular video. And it's not only about getting this additional income, but also after you deposit or after you invest this capital, you can get this additional income in the same year without having to wait for so many years before you get this income into your bank account. So stay tuned, share and subscribe to as many people as you can so that they can as well get advantage from this specific video as well as all the videos I'm going to share on almost every alternate days. So first things first, let's see about the two methods which I'm going to share in this specific video, and one specific method I'm going to cover in more detail, allowing you to determine those specific assets. So the first method is, obviously, if you have capital, you can go right away and invest into real estate. From this investment in real estate, then finally you have to wait for a period of time, you have to wait for multiple years before you start fetching rental income, isn't it? And moreover, real estate is capital intensive. You need to have a lot of capital to invest, and if you don't have capital, you need to rely on bank to provide you loans. Nevertheless, even if you have to invest in real estate, you need 10% of the complete real estate value, and over and above you need to pay stamp duty and all other additional overheads with respect to capital. So is there an easier way compared to real estate? Now you might say the real estate I can buy ready to move, but ready to move, my friends, is even more expensive than an under construction property. So you can decide for yourself. I'm not biased here. If you have a lot of capital, real estate is one of the options where you can put in capital and then start earning your rental income. But nevertheless, keep in mind the rental yields which you might be fetching from your investment. Mostly in India, the rental yields are quite low, around like 1.5 to like less than 3%. If you're getting a rental yield of about 4.5% from your investment in real estate, then voila, you can go for it. The second option comes here is now dividend investment. You can invest in stocks which provide you dividends. Now here, while investing in stocks, here itself you have an option of investing into real estate investment trust. These real estate investment trusts actually put their money into real estate which fetch them rental income, and this rental income is then distributed to the shareholders. This is one of the options. The second option is you can invest in any other company which are paying you high dividend yields. Now we are going to see some of the terminologies here before we filter out these assets, before we filter out our REITs or any other industry stocks. As a matter of fact, let us understand some of the terms which are being used commonly to determine the best dividend paying companies. The first parameter is dividend yield percentage. So we are going to see how we are calculating dividend yield percentage. Then the second aspect is dividend payout ratio. This is also an important factor to determine whether it's not only going to give us dividend, but additionally it's going to also have capital appreciation over a period of time. So now let's see what is dividend yield. Dividend yield is what dividend the company pays out to you divided by the current price of the company. That means based on the current price, you would have to decide your capital, how much you want to invest. So based on your invested capital, that much percentage yield you will be getting. For example, if a stock, say A, is providing you a dividend of 10 rupees and the stock is trading at a price of 100 rupees, then the dividend yield is 10%. 10 divided by 100, that's around 10%. So your yield, basically the dividend which you are going to get on every share which you invest in the particular company, is going to be 10 rupees. For example, if you invest 100 rupees to buy this particular share, you're going to get 10 rupees in the specific year. If you invest 200, you're going to get 20 rupees. So nevertheless, 10% is a good dividend yield, beating fixed deposit rates, beating even the corporate deposit rates. So it's a fantastic way to earn additional income along with your job, as well as getting capital appreciation on the stock. Now let us see what is dividend payout ratio. Dividend payout ratio is the amount of dividend the company pays versus the earnings it has earned. For example, the company might be earning around like 1000 crores of rupees, and out of this 1000 crores of rupees, it may be giving a lot of dividend, so many crores of rupees. Out of the 1000 crores earned, it might be giving all 1000 crores to the shareholder. That is the 100% dividend payout ratio. So that's the way it's calculated, the dividend payout ratio. You can directly take the dividend of the company and divide it by the earning per share of the company. That will give you the dividend payout ratio. Now, how are these two terms very important before you filter out the companies? Now, we need to check these two aspects from a historical perspective. We need to check it from a 5-year historical perspective as well as a 10-year historical perspective for all the companies which have dividend payout of a very significant value of what you are expecting. For example, your expectation is more than the fixed deposit rate or more than the inflation, that is which is 7%. So then you can filter out dividend yield greater than 7%, and you can have a look at all those companies along with also the dividend payout ratio. You might expect that the company not only pays the entire earnings as dividends, but you might also expect to keep some of the earnings so that it can utilize it for growth and give you capital appreciation. And along with that, it's also giving you dividends. So you might want to keep that percentage lesser than 80%. The dividend payout ratio should be lesser than 80%, so that 20% of it can be reserved as surplus so that it can invest for future growth. So these are the two parameters. You can use it in one of your favorite tools. Screener.in is one of the tool. I'm not promoting the tool. There is moneycontrol.com as well. You could use either of them to filter out your dividend payout companies, dividend yield companies, as well as slightly lower dividend payout ratio companies. So these are the two parameters you need to keep in mind before you filter out your favorite companies and invest your capital. Now I'm going to share with you some top three companies which are my favorites and which have typically shown a very stable rise in the share price as well, giving you capital appreciation as well. Nevertheless, you also need to invest into these companies by checking the valuations of this company at any specific point of time. The top three, the first one being Rural Electric Corporation. They are mostly providing finance to powerhouses, power companies, electrical utilities, electrical companies. They provide loans to them. And then there is this counterpart company called as the Power Finance Corporation, which is almost on the same business as what REC is actually doing. And then you have the third, you have GAIL. They are mostly into gas distribution. So these are the top three high dividend yield companies. The dividend yields are almost like 10%, more than 10%, and the ROE, return on equity, the return which they are having with respect to the capital you invested, so that you can hope for capital appreciation, the ROE is more than 15%, which I normally try to look at. So more than 15% is great enough. It's beating inflation, plus is the cost of capital in India. So these are the two aspects which you can look forward. The top two, find out the dividend yield and then find out the dividend payout ratio. Dividend yield percentage has to be as high as possible, more than the inflation rate as if possible. And then the second point, which is the dividend payout ratio, has to be lesser than 100%. You don't want companies who shell out the entire dividend to the shareholders. You want them to reinvest for capital appreciation as well. So hope you have liked this video. In case you have liked, or in case you have some thoughts going around your mind, trying to see some more content, you wanted some more explanation, please drop it into the comment section so that I can get back to you, or take this as a feedback to me so that I can improvise on my subsequent videos. So share, subscribe, and keep watching the content every alternate days. See you. Bye.